Jim Sanford, one stock you like over at Sag Harbor Advisors is Interactive Brokers. Now, earlier this week, they beat Wall Street estimates by a nickel on the bottom line. Stock's still down around 14% year to date. So tell me why you like it.
You know, this is a firm, it's only a 15 billion market cap, still pretty small. It has tremendous room to grow and take assets from its competitors like TD Ameritrade and Schwab and Fidelity. It's got savvier technology. As an RIA, Interactive Brokers is my custodian. I've used those other names as custodians as well, so I can speak from personal experience. In terms of a place that serves self-directed investors and fee-only RIAs like myself, it has the best execution. They don't sell the order flow. The execution is very honest. You can use algorithmic execution services there for free, which you can't do at other custodian or self-directed brokerages. 1.1% dividends, so you're paid. Wow, this company is really going to take market share, I think, from its competitors. A lot of room to grow. Again, only a 15 billion market cap.
And you also like Charles Schwab. Now, they met profit estimates earlier this week, and they reported their second quarter, but they beat on the top line. That stock is also down around 15 or 16%. But all the online brokers are having a rough year, TD Ameritrade, E-Trade. But tell me why you like Schwab in particular.
I'm staying with the theme overall that as millennials take over the transfer of wealth from boomers, there's going to be a shift of assets from the traditional hybrid, commission-oriented asset managers and the large wirehouses, shift of those assets to more lower fee, lower cost, self-directed brokerages or custodians that serve fee-only fiduciary RIAs like myself. It's got a 1% dividend, so you're paid to wait, about a 45 billion market cap. I think there's going to be a lot of assets shed from the traditional commission-oriented guys like Wells Fargo, which owns A.G. Edwards, Raymond James Financial, Morgan Stanley, et cetera. So it's really that long-term theme of the transformational shift of assets to the more independent, self-directed, low-cost shops.
Well, one of the big custodians of those assets, and particularly ETFs, is Bank of New York Mellon. This is another financial you like. A little bit off the beaten track, but still a very popular stock. Tell me why you like it.
Now, this is a bank that doesn't take dealer risk. They're not a credit derivatives dealer. They're a fee-based bank. That, again, like you said, they're the largest custodian for ETFs. I think over time, as this generational shift of assets that I mentioned goes from boomers to millennials, there's going to be more of an emphasis on passive investing. We're already talking about a lot about that in the conventional wisdom. Right now, they're the largest custodian and the preferred counterparty. Decent dividend, 1.73%. That's well north of the 10-year Treasury, only about 50 bips south of the 30-year. So that's a stock you get paid to own. Not a lot of risk, not volatile, as it continues to, take market share or pretty much benefit from the taking market share of passive investing from more active commission-oriented managers.
And then finally, let's talk about one of the biggest asset managers of them all, BlackRock. This is a stock you like, and you like it because of their passive investing. You like their iShares ETFs.
Absolutely. This is the poster child of passive investing. They're the best positioned in terms of competing in a lower cost environment. It's got a 2.57% dividend. I think, again, to repeat again, as assets shift to millennials, they're going to shift towards more passive investing away from commission-oriented management. It's a big company, without a doubt. It's got trillions in assets, and I think it can get bigger.
All right. Well, thanks a lot, Jim.
Thank you.
And thank you for watching The Street.